If you're an AQA A-Level Business student looking for a video to revise all of Unit 2, Managers, Leaders and Decision Making, well, this video is for you. Because we're going to go through everything that you need to know for your exams, including what the difference is between management and leadership. We'll also go through all the different leadership styles along with their advantages. And then we'll look at Tannenbaum Schmidt Continuum. Then we'll go into our decision trees and look at the different influences on decision making. And then we'll finish off the session looking at our stakeholder maps. Let's get into it. So the first topic in this revision session that we'll take a look at will be the difference between management and leadership. So first of all, I want to really understand what are managers. Now, all a manager is that they are people in the company who are responsible for planning, organising, leading and controlling a business's activities and their resources. Now with a manager, it's more of a job title and a position within the organisation, and we've got three different levels. We've got your senior managers, middle managers and your lower managers. Now your senior managers are those at the top of the organisational hierarchy, so people like your CEO, your chief financial officer, your chief marketing officer. And these guys are mainly responsible for the strategic decision making of the business. And what I mean by strategic decisions is that these are decisions that impact the business's long-term strategy. So they'll be mainly focused on the long-term goals of the business. And then we have your middle level managers. Now these will be your head of departments, your regional managers. So the strategic decisions that your senior managers are making, it's the middle level managers who are responsible for implementing those strategies. And they will look to help allocate resources and manage the budget of the different areas. And then finally, we have your lower level managers or your junior managers. These are people like your supervisors and your team leaders. And they're not really focused on the strategy of the business. They're more working in the day-to-day operations and the activities. So their main focus isn't on the long-term goals of the business, it's to try and achieve the short-term goals. And now we've understood what a manager is, it's important to understand what a leader is. Now a leader, they don't necessarily have to be managers. You would hope though your managers are good leaders. But all a leader is someone who guides, motivates and inspires others to achieve common goals regardless of their level of authority. So as I said, you don't need to be in a position of management to be a leader. You are just inspiring those people around you to try and achieve that common goal. So what is the key difference then between management and leadership? Well, it's your manager's job to execute tasks and maintain orders, whilst leadership is really about inspiring a vision and driving change for the future of the business. And the next topic that we'll take a look at in this revision video, which is a nice follow-up from looking at the difference between management and leadership, we'll be taking a look at now our different leadership styles. Now, there are 4 key ones that you need to know for your exam. So what we're going to do, we're going to have a look at what each of those leadership styles are, and of course the advantages of each. Starting off with your autocratic leaders. Now, an autocratic leader, they like to make the decisions by themselves. They don't necessarily like to delegate that decision-making authority to their subordinates. So what you'll find is that those autocratic managers, they'll make the decisions and then tell their subordinates what to do. So what you can see is that the communication is flowing one way. It's coming from the top of the organisation down. Now, I know it can sound a bit of a harsh leadership style because you're not getting your employees or your subordinates involved with decision making. However, it can be quite useful. The main advantage of an autocratic leadership style is that it can lead to quicker decision making because you're not consulting your subordinates or your employees about what they think the decision should be. You're not delegating that authority either. It's just that one individual who makes that decision. So in times of crisis, an autocratic leadership could actually be quite useful, or when operating in a dynamic market. And as well, if you have a very influential leader, well, their strong vision will provide a lot of clarity and direction to the team. Now, if you have a team of individuals who lack skills or lack the experience, they want that guidance, and that's also why an autocratic leader could be quite useful. And as well, the individuals, the subordinates, they know exactly what is expected of them. So once again, if they are lacking skills, if they are lacking experience, the autocratic leadership style can be quite beneficial. The next leadership style that we have is our paternalistic. Now, whenever I think of the term paternalistic, I think it sounds very similar to parent. Now, a paternalistic style is kind of what a parent leadership style is. Now, there is a lot of commonalities between the paternalistic and the autocratic leadership style. And the similarities that they share is that the leader will make the decisions without really delegating. But with a paternalistic leadership style, The leader is making the decision with the best interest of their employees. So what you'll find is that this leadership style now offers a lot more guidance and support, where the autocratic leader basically makes that decision and just tells everyone what to do and they are just expected to follow those orders. Whereas the paternalistic leadership style will obviously provide that decision and direction for the employees, but also mentor them. Because the paternalistic leadership style is really focused on employee growth and development. So rather than just telling their subordinates the decision, they try to explain it, but still ultimately it's the paternalistic leader who will still have the decision-making authority. They aren't really delegating it. Now, what we could argue is that, especially over an autocratic leadership style, that you may find paternalistic leaders has better decision making because they're really focused on the employee development. And if we are showing that we care for our employees, maybe the level of employee morale would go up. And of course, if employee morale goes up, employee engagement goes up, motivation goes up. So we may also see higher levels of productivity. And of course, the enhanced guidance and support that paternalistic leader will provide the employees, once again, just helps the skill development of the employees. The next leadership style that we'll take a look into will be our democratic leaders. Now, imagine you had a spectrum. At one end, we've got autocratic, who makes all the decisions and tell their employees what to do. Your democratic is at the other end of the spectrum. Because now what a democratic leader likes to do is that they like to delegate a lot more. They like to consult with their employees. So rather than making all the decisions themselves, they speak with the employees. So you find that communication is now flowing two ways. And the reason why we are now communicating more with our employees is because the democratic leader, they recognize that their team can have valuable input. So the idea with a democratic leader is that they want to start empowering their team members. And that empowerment can lead to more motivation because we show that we trust the employees. You know, you could relate it to potentially self-esteem from Maslow's hierarchy, or we could look at the motivator factors from Herzberg's two-factor theory. And interestingly, research has actually shown that the democratic leadership style appears to be the most effective. Now, because the democratic leader is also opening this two-way communication, they're speaking with their employees, they're gaining their input, what you also find is that it will encourage more diverse ideas. And your workforce may start to become more creative because they've got more room now to be a bit more creative because we're delegating more of that decision-making authority. And the team members will start to take more ownership of the decisions, once again improving the overall autonomy of them. And the final leadership style we have now is called laissez-faire. Now, laissez-faire is actually a French term and it translates to let things be or let things take their own course, which essentially means the leader isn't really providing a lot of guidance and a lot of support. They actually provide a minimal supervision. So what the laissez-faire leadership is all about is to give employees that freedom so they can make decisions by themselves. So we are now completely delegating all responsibility and authority to our subordinates, to our team members. Now it can sound like a laissez-faire leader is just completely absent, providing no support for the subordinates. And this can sound like a negative thing. But laissez-faire leadership actually can have its benefits. Now, it works especially well when you have skilled and experienced employees because you are now providing them with ultimate autonomy over their work, and this can increase job satisfaction because what the employees now have is that they have more room to be creative and more innovative. Because the problem is when you're trying to supervise employees when they are being creative, a lot of them wouldn't work well under that type of pressure because the leader may start getting involved and not giving that room for them to make failures or make mistakes. And as I said earlier, it works extremely well when we are working with experts because the leader may not have the necessary skills required to make that decision. Their team members may have all the skills that they need, so we just want to let them get on with it. Now, in your exams, when you are evaluating which leadership style is the best, it kind of depends on the situation. You know, who are we leading? Who are our subordinates? And what is the situation? And what a good leader will do is that they wouldn't just stick with a single type of leadership style. They would try and adapt their leadership style depending on the situation and who they are working with. The next topic that we'll take a look at in this revision video will be about Tannenbaum Schmidt's Continuum. Now, once again, this follows up quite nicely to what we've been doing. We've looked at the difference between management and leadership, and we've taken a look at the different leadership styles. Now, essentially, the Tannenbaum Schmidt's Continuum is just another model that looks at the different leadership styles, ranging from a real manager-centered leadership style, more of an autocratic, to more of a subordinate-centered leadership style, more of a democratic. So essentially it looks at how a manager is treating their subordinates. Are they delegating the decision-making authority to them, or is the manager doing all the decisions and just telling the employees what to do? Now, we've got 7 different sections as part of Tannenbaum Schmidt's Continuum. I'm going to explain what each of them are now. Just important to know, as you can see, further left in the model is more of an autocratic approach. The further right is more of a democratic approach. Now, starting off with the tells. Now, essentially, the leader will make the decision and then tell their subordinates what to do. So your subordinates will have zero involvement in the decision-making process. Now, this is the most extreme form of an autocratic leader that we have, because there's no delegation and there is absolutely no decentralization. So this may actually lead to higher labour turnover due to the lack of autonomy and empowerment for our employees. Now, once again, it could work quite well. Works well in crisis management, in high-risk environments, or when you're dealing with new employees. Then we have the cells. Now, this is when the manager will still make the decision without input from subordinates. However, they will start to explain to the subordinates why they've made that decision. But the thing to know is that no matter what the reaction is of the subordinates, the decision won't necessarily change. So managers still make decisions by themselves, but they will persuade and educate the subordinates that the decision is in their best interest. So subordinates may start to feel that the manager has some concern for them, and they may try to overcome any resistance that the employees may give. Now, we have more to suggest, so we're moving away from the use of manager's authority. And this time, the manager will still make the decision without input from the subordinates. They will explain to their subordinates why they made the decision. Then they will allow their subordinates to ask any questions to understand the decision. Now, this gives subordinates now the opportunity to ask questions about the decision, so once again, they can learn from it. Then we have a consult, so we're slap bang in the middle. So now, managers, they will make a provisional decision. And what we mean by a provisional decision is that it will be subject to change. And then they will invite discussion from their subordinates to get their views to potentially modify the decision. So now what we're seeing is that the manager starts to recognise that their subordinates have valuable input. We're getting further over now to more of the democratic approach. We have the joins, and this is when the manager presents the problem to their subordinates to work together on creating the solution or decision. Now, the manager, they will still make the final decision, but this time subordinates feel a little bit more motivated due to higher levels of empowerment and autonomy in that decision-making process. Now we've got a lot more freedom for our subordinates. We've got delegates. So the manager will tell their subordinates the problem, provide different constraints such as the resource budget, and the team will then solve the problem and come up with the final decision. And at the very end, we've got abdicates. And this means formally giving up a position of power or authority. So this is an extreme form of democratic. So now your subordinates have full freedom to define and solve their own problems. However, the problem with this is that there can be a lack of direction for them and lack of coordination if the subordinates don't necessarily possess the necessary skills. So once again, abdicate works well with your experts, not so well with your new employees. The next topic that we'll take a look at in this revision video will be identifying the difference between scientific and intuition decision making. So what we're going to do is I'm going to explain what scientific decision making is and then what intuition and the key differences between them. Now, kind of in the name, a scientific decision is basically when we are using data and evidence to make our decision from. So what we want to do, we want to conduct some market research. We want to look at making decision trees. We want to analyze the data and then base our decisions from evidence. Now, typically you'll use scientific decision making when you're committing a lot more resources into the actual decision. Because if we are looking to invest £1 million into a certain project, we don't really want it going off a gut feeling. We want hard evidence. We want data to support that decision. And then we have our intuition decision making. So this is really when we're using our gut feeling to make our decisions. So we're basing it on instincts, our personal experiences, rather than gathering data, analysing that data to make that decision. we're just going off what we think is the right thing to do. Now, typically intuition decision making will be used in startup businesses where maybe they don't have a lot of data, or when you're talking with someone who is highly experienced and they've made similar decisions like this over and over again. Now, once again, if you are looking at investing in a project which is going to require a lot of resources, a lot of time, a lot of effort, mainly you would go for more of a scientific approach. Or when we'd rather use our intuition decision making, this is when we don't have enough data, the data may be out of date, or it's only a smaller decision. So we don't need to commit as many resources or as much time into the decision. The next topic that we'll take a look at, following up quite nicely from the difference between intuition and scientific decision making, we'll be having a look at our decision trees. Now, essentially, a decision tree is what we can see on the screen. We've got a couple of different options and we're trying to figure out which is the best to invest into. So on the screen here, we've got two decisions that we're looking to invest into. We've got either an advertisement campaign or a new product. Now, in year 13, we'll learn about a topic called Ansough's matrix. And essentially what this decision tree is all about is, should I look for a market penetration strategy or through a product development strategy? But essentially what a decision tree is, we've got these two different options. Now, you can see two numbers in red in brackets. That represents the investment cost into each decision. So with the advertisement campaign, we're going to spend £35,000. With the new product development, we're going to spend £40,000. And then off each of those options, we have two more branches. Now we can see £100,000, that is the potential payoff. And we can see underneath that, it's got the number 0.4. Essentially, we are saying that there's a 40% chance likelihood that the advertisement campaign is going to be successful. So there's a 40% chance likelihood that we would have a £100,000 payoff. Versus we've got a 60% chance where we're only going to have a £10,000 payoff, which essentially means the advertisement campaign hasn't really worked that well. When looking at the new product, we're looking at investing £40,000. All we're saying is we've got a 30% chance likelihood it's going to be really successful and we're going to have a £150,000 payoff. However, we've got a 70% chance that it's not going to do that well and we're going to have £1,000 payoff. Essentially, we're going to lose money on the deal. Now, there are a couple important calculations that we need to do for this, but just as a quick side note, those two probabilities should overall add up to 1 because there's a 100% chance likelihood it's either going to go really well or really bad. Now, we want to start calculating the expected value for each of the different options. So what we want to do is we want to take the payoff and multiply that by the probability of the outcome. So here for the first branch, we do £100,000 times by 0.4 times by 40%, which would give me £40,000. Then we do it again for the second branch, we do 0.6 times by 10,000 to get me £6,000. And then we're going to do it as well for the new product. So 0.3 times £150,000 gives me £45,000. And then we've got 0.7 times by 1,000, which gives me £700. Now, to calculate the expected value, I want to add each of those two branches together. So we do £40,000 plus £6,000 gives me an expected value for the advertising campaign of £46,000. Then we do the exact same thing again for the new product. We do your £45,000 plus 700 to give me an expected value of £45,700 for the new product. And then the last thing that we need to do is now calculate the net gain. Then the way we calculate the net gain is that we take the expected value minus that initial investment, so the initial investments that we have in red. So as we saw from before, the expected value for option 1 for the advertisement campaign was £46,000. Now all we need to do is minus the £35,000, that initial investment, to give me a net gain of £11,000 for the advertisement campaign. Then we do the exact same thing again for option 2. We have the expected value of £45,700 minus the initial investment, that initial cost of £40,000, to overall give me a net gain of £5,700. Now, when making that ultimate decision, you realistically want to go for the option with the highest net gain. So for this example here, you want to go more for the advertisement campaign rather than the new product. However, there is some evaluation that we can make, because when looking at the payoff, if the project was to be successful, we can see that the new product has a lot higher return than the actual advertisement campaign. But what we want to do is we want to factor in the risk probability, is that there is a lower probability of the new product being successful in comparison to the advertising campaign. But the thing that you also want to know is that these are just estimates. We are just thinking, well, we may get £100,000 if it is successful, and we are just predicting that it will be 40% successful. So when you are evaluating it, make sure you're looking into the reliability of those estimates. Just a quick one, if you are looking for a bit more support with A-Level Business, whether that's improving your confidence with the content or giving you more support around your exam technique, I run a tutoring program that gives you all the support that you need for your A-Level Business exams, whether you are in year 12 or year 13. As we offer one-to-one support, small group sessions, online courses, online resources, messaging support, and so much more. If you want to apply for the tutoring program, feel free to check out the links in my bio. Back to the video. The next topic that we're going to take a look at in this revision video will be introducing some key terms for you. That will be risk, uncertainty, and opportunity cost. Now, starting off with what risk is, I've mentioned this term quite a few times already in this revision video. Now, what we mean by risk is the potential for negative outcomes where the probabilities of these different outcomes are known. And that's going to be the real key difference between risk and uncertainty, is that we know the risks, but we don't know those uncertainties. So just examples of risk, well, maybe that we are looking into launching that new product like we just did with that decision tree. So what our market research might identify is that there's a 30% chance likelihood of our overall sales beginning to decrease. There's a 10% chance likelihood that our customers may be dissatisfied with the quality, and there's a 5% chance likelihood that we may have a negative brand reputation from this, because we know launching new products can be a risky thing to do, because there's no guarantee that our customers will like the new product that we're launching. So we want to look at these risks and identify, well, what's the negative outcomes? So for example, looking at the negative brand reputation, this will start to reduce the number of loyal customers that we have, and then we can continue with our chains of analysis after that. Next up, we have our uncertainties. So as we said before, a risk is known, where an uncertainty, the situations where the outcomes of decisions are unknown, and the probabilities of these outcomes cannot be accurately predicted or quantified. Now, there will be many different scenarios which are impossible to predict. So casting your minds back to the start of 2020, there was a lot of uncertainty around COVID and the impacts this would have on different businesses, because no one really knew what was going on. No one knew how long the lockdowns would be for. No one knew how long it would be until the vaccines would come out. And at that point in time, all of this was unknown. It was an uncertainty. So just a couple different examples of uncertainty. We've got our economic conditions, what inflation is going to be, whether we're going to be in a recession, what the interest rates are, whether the economy is growing or is going to be declining. We've got other external factors as well. So looking at pestle, we've got our political environment, so the different legislations in place. We've got economic, where we've just been through, different social trends, different technological advancements, the legal environment changing, and also environmental factors. Then we've got the actions of competitors. Now, once again, we know they're going to outcompete us, but we just don't know how they're going to do it. And finally, any other global events, such as political instability, maybe there is a war, conflicts between different countries, trade wars happening, any different natural disasters, another pandemic, and so on. And the final key term that I want to introduce will be about the concept of an opportunity cost. Now, all the opportunity cost is the value of the next best alternative forgone when a choice is made. Now, looking at this in terms of an example, let's say I've got £100,000 and I can only invest in one of these two options. I can invest in an advertising campaign or a new product launch. And let's say for whatever reason, we've decided to go ahead with the advertising campaign. Now, what the opportunity cost would ask is, what benefit could that new product launch have given me? So when we're thinking about this, we're looking at the potential revenue that we've missed out on, the increase in market share that we could have experienced. Maybe it would have gave the business a strategic advantage because that new product could have been really innovative. It could have helped us diversify our portfolio, so offering different products, spreading the risk across different products, maybe got benefits from economies of scope, and as well the new customers that we could have gained from launching that new product. Now, it can be quite difficult for us to quantify these benefits, but that's why we've got different different investment appraisals, the payback period, average rate of return, and the net present value, which is more of a year 13 topic that we'll learn about in Unit 7. But we've also looked at decision trees, and that will also help us quantify the opportunity cost. The next topic that we'll take a look at in this revision video will be the different influences on decision making. Now, there's a few different factors that we've got. We've got the mission and the objectives of the business. We've got different ethical dilemmas. We've got the external environment, and finally resource constraints. What we're going to do is we're going to break down each of these and explain how it could influence our decision making. Starting off with the business's mission. Now, we looked at in Unit 1 what a mission and mission statements are. And essentially these will be the strategic decisions of the company. So they're not really that specific, but they influence the entire direction of the organization. Now, when we look at the mission and the mission statement, essentially it explains why the business exists. So therefore, whenever we're making a decision, we have to ask the question, is this going to help the business meet their overall mission? Because if our decision making doesn't align with our mission, it can then give the business a negative brand reputation because it looks like the mission statement is purely just a marketing tool. Next up, we have the objectives. Now, these could be either your corporate objectives or your functional objectives. Let me give you some examples of some functional objectives. So for example, if we look at the business function with marketing, it could be around increasing lead generation by 20% through targeted marketing campaigns. I'm not going to go through each of them. Let's say with HR, it's to develop 5 training programs for the sales and marketing teams to enhance their skills within the next 3 months. Is the decision going to help us meet the overall objective, whether that's corporate or the functional? And when we are setting these objectives, remember we use the acronym SMART: specific, measurable, achievable, relevant, and time bound. So it's going to be quite easy to understand whether that decision has been successful or not. The next influence on our decision making will be around ethical dilemmas and ethics. Now, what do I mean by ethics? Essentially, it's doing the right thing. It's the principles that govern which behaviours are morally acceptable to society, individuals, or different groups. Now, essentially, being ethical goes above and beyond what is legally required of you. And essentially, when we're looking at how ethics can influence our decision making, it's because typically there is a trade-off. And what I mean by a trade-off, to get more of one thing, you have to sacrifice the benefits of another. So essentially, if you want to be more ethical, there'll be a trade-off with profits. So to become more ethical, you're typically going to experience less profits, but vice versa. If you want to experience more profits, you may have to make less ethical decisions. Let's say we're using environmentally friendly materials. Now, for profit-wise, this can actually increase our costs. So our cost of sales, our variable costs go up because we're spending more on the materials. And of course, an increase in cost could lead to a decrease in profits. However, we could therefore argue that ethically it's the right thing to do because we're reducing our environmental impact and we're promoting sustainability. Once again, of course, there is evaluation because if we are more ethical, then potentially our brand reputation increases. More people want to spend their money with us and they're happier to spend on higher prices. And another important factor that influences our decision making will be the external environment. Now, if the external environment is going through rapid change, this makes decision making very difficult due to the high amount of risk and uncertainty. And we've already identified what risk and uncertainty is. Now, certain markets that typically experience a lot of rapid change within our dynamic markets, think of the technology industry and the fashion industry. Consumer trends and needs are changing all the time. Now, when we look at the external environment, first of all, use PESTLE: political, economic, social, technological, legal, and environmental. And we will go through PESTLE in a lot more detail across Unit 7. But of course, our competitors and what our competitors are up to, whether they're trying to get a competitive advantage over us or not. Now, all of this is outside of the business's control. We can't control what's happening in the external environment. I can't control my competitors' actions. I can't control the exchange rates. So what a business would have to do is that they would have to be reactive to the external environment. So if something was to change, they have to react to it. Now, we can anticipate certain changes and we could get the benefit from there. But most of the time, a business will take a reactive approach rather than a proactive approach. And the final topic that we'll need to take a look into in this revision video will be stakeholder mapping. Now, a stakeholder is any individual or group of people or organizations that have a level of interest in our business, or they are impacted by the decisions that we make. Now, essentially, a stakeholder map tries to categorize our different stakeholders based on their level of influence of the business and the level of interest that they have. So we have 2 key axes. we have the power, and we have interest. Now, our stakeholders who have high power over the business, so they have a lot of influence over our decision making, and they are very interested within the decisions that we are making, these are our managed closely. So for example, this could be around the shareholders of the business or the senior management. So these stakeholders will have major influence on our decision making. So we want to make sure we are prioritizing their needs. We need to make sure we're communicating with them and build a strong positive relationship. And then we have the stakeholder group, which has a high amount of power, but a lower level of interest. And these are our keep satisfied stakeholders. Now, essentially, how we manage these stakeholders is that we want to keep them satisfied. So if they did have any concerns, we want to make sure we're addressing these as quickly and as effectively as possible, because they can really influence our decisions. So we want to engage and consult with this group when possible. We don't require ongoing communication and them to be involved in every single decision, but we have to know that we are satisfying them with the decisions that we're making. And a great example of a stakeholder in this group would be the government. And then we have our stakeholders who have a high level of interest but a lower level of power. And these are our keep informed. Now, once again, how we manage these is that we want to keep them informed with our decisions. So they will be very interested in the decisions that the businesses make, but they don't necessarily have a large influence over our decisions. So now we want to provide them with regular updates. We want to communicate a lot more with them. So we just want to basically tell them this is the decisions that we're making. Now we also want to show that we care for these stakeholders, that we don't want to just start exploiting them. So examples of our keep informed could be the lower level employees or smaller customer groups. And finally, we have our stakeholders who have a low level of power and a low level of interest. The way we manage these is that we just give minimal effort into them. So whenever we're making a decision, we don't necessarily want to prioritize them in that decision-making process. So an example of minimal effort stakeholders could be a local community that is situated 10 to 20 miles away from us. Because realistically, they're not going to be impacted that much in the decisions that we make, and they won't really be too interested in it either. But with these minimal effort stakeholders, we do want to monitor them because their power or their interest may change over time. If you found this video useful and want to continue with your revision, then I highly recommend you check out our video here on Unit 3 Marketing, because we're going to go through some real important concepts such as price and income elasticity of demand. We'll also take a look at market research, then we'll look at the difference between a mass and a niche market, and then we'll also go through the marketing mix. I really hope these videos have been helping you guys out with your revision. Thank you so much for watching, and I'll see you in the next one.